Hey guys, it's Victor with BCM and welcome to part one of Learn About Options. So options investing has gotten pretty popular over the past few years. It wasn't always like that. Once upon a time, options were like a dimly lit corner of the investing world, but today there's just so much information available. There's so many new tools that options investing has become a lot more accessible. But that being said, options are still not as mainstream as investing in funds or trading stocks. And options are also more complicated than either of those things. So this series is a primer on options to help people who are just starting out understand the basics and to help them build some good foundational knowledge because options get very complicated very quickly. In this first part, we're going to start with the very basics, like what are options to begin with. Next, we'll cover some basic option terminology and also look at how to make sense of option contracts and quotes. And then last, we'll look at the basics of option pricing so we can understand how options derive their value. Okay, so what are options? Before we get to that, it's important to know that there are different types of options. Okay, there are options on stocks, on bonds, on interest rates, on indices, there's non-traded options, and so on and so on. We are talking specifically about American style publicly traded stock options or equity options. These are the most common type and it's usually what people are talking about when they say they're trading options on stocks. So in those terms, an option is an investment contract that gives the owner of the contract the right to buy or sell a specific stock. That specific stock is usually called the underlying stock or the reference stock. So again, an option is the right to buy or sell an underlying stock, or it's the option to buy or sell. That's why it's called an option. Now, option contracts, even though they are associated with an underlying stock, they are separate from the underlying stocks, meaning the option contracts themselves, they have their own prices and they can be bought and sold separately on an exchange just like the stocks can. We're going to go over some basic option terminology. Options have a lot of jargon and it can sound like its own language. Now, there's a lot more to options than what's on this page, but just think of these as the bare minimum. These are the bare minimum terms we have to understand in order to have an intelligible conversation about options. The first term is call option. A call option is the right to buy 100 shares of stock at a specific price. So again, a call option is the right to buy 100 shares at a specific price. A put option is the opposite, right? The put option is the right to sell 100 shares at a specific price. Sometimes people will refer to this right, so the right to either buy or sell, as control. So we can say a call option controls 100 shares, or a put option controls 100 shares. Now the specific price in the option, that's called a strike price. Sometimes it's called an exercise price. What it is it is the specific price in the contract that we can call or put stock at. Now notice we need to name this price. We call it a strike and not just price because an option can actually have several different prices at the same time. So it's very important to clarify which price we're referring to. The next term is exercise. Exercise is just using the right in the option. So for example, if we have a call option that gives us the right to buy shares at $10, well, the act of buying the shares for $10 with that option, that is exercising that option. So it's just using the option. Expiration. Expiration is very important because all options expire. They all have a maturity date. And so options are only in force, only good during the term of the contract. After the contract expires, the option becomes worthless. It's void. The next term is premium. Premium is the price of the option contract itself. Remember, we said option contracts can be bought and sold on an exchange, right? So when they're bought and sold, the price of those contracts, that's called the premium. One thing to note about premium is that it is quoted on a per share basis. Okay, so for example, we might see a call contract quoted at $1. But remember, every contract controls 100 shares. So we have to multiply that per share premium quote by the number of shares. So if we saw the quote for $1, we'd have to multiply $1 by 100 shares to get $100. So $100 would be the total cost of the contract. Last term is moneyness. Moneyness refers to the relationship between an option strike price and the underlying stock's price, right? Depending on how those two prices are positioned relative to each other, the option's either going to be out of the money, at the money, or in the money. We're going to go over an example later that will make this clear. On this page, we see why it is important to understand all those terms we just went over. On the left side of this page, we have a table with a list of call options and quotes for Apple stock. At the time, Apple was trading around $137. This table is called an options chain because it's basically a chain of option quotes. The chains are usually ordered by strike price, which we can see is the third column in this table, and here it goes from $140 all the way down to $200. This chain is from Yahoo Finance, but these quotes and these chains, they're available for free all over the internet. I'm using Yahoo here because it provides the actual contract names that the exchange uses, which isn't always shown by all providers. The names of the contracts are the first column, and if this is your first time looking at an option quote or a contract name, it probably just looks like a bunch of gibberish, a string of letters and numbers. But it's easy to understand what we're looking at once we know what we're looking at. So on the right side of the page, we're going to break down that first contract from the table using different colors for reference. The first part of the contract in black, AAPL, is just the ticker or the symbol for the underlying stock, which in this case is Apple. The second part in orange is the expiration date of the contract. This contract expires on July 15th, 2022. Something to note is that option chains are usually ordered by expiration first and then strike price. So all of the strikes on this chain, for example, they all expire on July 15th, 2022. And we could go to another expiration month like September or August or something else. We could pull up those chains and then we would again see all of the quotes ordered by strike price. The third part of this contract name in blue is telling us that this is a call option. That's what the C stands for. C is for call. If this were a put option, then we would see a P instead. And then the last part, shown in purple, is the strike price for this contract, which is $140. Now, this is a call contract, so this contract represents the right to buy Apple stock, 100 shares of Apple stock, at $140 until July 15th, 2022. If this were a put contract, then it would just be the opposite. We'd see a P instead of the C, and this would be the right to sell 100 shares of Apple at $140. Now, something to notice here is that this call contract with $140 strike price has a higher strike price relative to the underlying stock price. Remember, Apple is trading around $137 right now. So because of this, we would say this call option is out of the money. It's out of the money because we would not want to use this contract to buy Apple at 140 when we could just go out in the market and buy the stock for 137. So because of that, this contract is out of the money. Notice that actually all of the options shown here on this chain, all of them are currently out of the money because the strike prices are 140 or higher. all of those prices are higher than Apple's market price of 137. Now, if Apple were trading much higher, let's say Apple were trading at $300. If that was the case, then all of these calls would be in the money. In the money because, for example, we could use this call to buy Apple at 140, and then we could just turn around and sell the stock at $300 a share, which is the market price. In that case, these would be in the money. Now, if the strike price and the market price are very close, let's say they're both 140, then the option would be at the money. So that's what moneyness refers to. The last thing on this page to go over are the bid and the ask price. The shown in green and red, it's on the right side of the page. So these numbers reflect the current premium or price that we can either buy or sell the contract at. So the bid price, which is shown in green, that is the current price that others are willing to pay for the contract. So in other words, if we want to sell this 140 call, we could expect to receive somewhere around $6.55 per share or $655 for the entire contract. The ask price, shown in red, that is the current price others are willing to accept or take for the contract. So if we want to buy this call, we could expect to pay somewhere around $6.80 a share or $680 per contract. So the bid is what we get when we sell, and the ask is what we pay when we buy. Okay, so now some of you may have noticed and may already be wondering, why is this $140 call option? Why is it trading, at over $600 if it is out of the money? In other words, why is anyone willing to pay $655 to buy this $140 call when Apple's only trading for $137? Well, we'll answer that next. There are two parts to an option's value. The first part is called intrinsic value. This is the difference between the strike price and the stock price, which we know is moneyness. In the previous example, when Apple is trading at 137, the $140 call had $0 of intrinsic value, and it was out of the money. The second part is called extrinsic value, and this is the potential for the stock price to move favorably versus the strike price. Just because Apple is trading below 140 doesn't mean that it's going to stay there. There's actually a pretty good chance that Apple's stock price will go above 140, and in that case, the $140 call would become in the money. So we can think of extrinsic value as reflecting potential future intrinsic value. And so that's why the $140 call was still trading above $600 despite being out of the money. Now we can distill overall option pricing down to just a few factors. The first one is the difference between the strike price and the underlying price. We know that reflects intrinsic value, but the underlying stock price itself, by itself, will also affect option value. Generally speaking, and all else equal, the higher the stock price is, the higher the premium value will be. The remaining factors that we see, 2 through 5, they all affect extrinsic value in some way. The most important one is time. Remember that all contracts expire. And the more time there is prior to expiration, the higher the opportunity that the option could become in the money or become deeper in the money if it already is. So time is a very important factor, and it's so important that many people use the term time value and extrinsic value interchangeably. They think of them as the same thing. The next factor, volatility, is also important. This refers to how volatile the underlying stock price is. All else equal, the more volatile the stock price is, the higher the premium is. Because just like time, the more volatility there is, the more potential there is for the option to have more intrinsic value. The last two terms, interest rates and dividends, the basic rule for these are that all else equal, the higher rates and the higher dividends are, the lower the premium will be. In practice, these two factors are usually the least relevant, especially when we're dealing with very short-term options that only have a few weeks or a few days until expiration. And that's because interest rates generally have been very low, and they still are quite low. And not all stocks have dividends. And even when they do have dividends, they're only paid periodically. But that being said, these factors can still affect option pricing, especially, for example, dividends when they do occur. Calculating extrinsic value can be pretty complicated. There are all kinds of models that people use to estimate option value. One of the most well-known is called the Black-Scholes option pricing model. That's summarized here on the bottom right. Realistically, we don't need to know these formulas. We don't need to perform these calculations because today all the option pricing is done by software and computers. For the most part, we can assume that the option quotes coming off the chain already consider all these factors, right? That's how those prices are derived, and they're the result of calculations done by all the dealers and the market makers that run the option markets. And if we accept that, then we can just estimate extrinsic value as simply the difference between an options quote minus the option's intrinsic value. For example, back again to our $140 call example, since we know that call had $0 in intrinsic value, we can just say that all $655 of that option's value was attributed to extrinsic value. Okay, now that we know what options are, we understand basic option terminology, we know how to read option quotes, we even understand how options are valued. The next step is to look at some examples of how options actually work. Walk through actual option examples. That will help us better understand their benefits and their drawbacks and how investors actually use them. And we'll do that in part 2 of Learn About Options. Here's a quick summary of part 1. Stock options are investment contracts that represent the right to buy or sell 100 shares of an underlying stock at a specific strike price for a specified period of time or expiration. From an option owner's perspective, a call option is the right to buy, and a put option is the right to sell. Just remember that we call it over or we put it away. Options are exchange traded just like stocks are, and options have their own prices, which are called premiums. Those premiums consist of both intrinsic value, which is the difference between an option strike price and the underlying stock price, and premiums also have extrinsic value, which represents the potential for intrinsic value. And that is affected by a number of factors, the most important of which are time and volatility. That's it for part 1. Please watch part 2 to continue this series. I hope you enjoyed this video or found it to be informative. If you did, please like, subscribe, share the content. If you have any questions or comments, just leave them below and I'll do my best to respond. Thanks again for watching.